Hey guys, how we doing? This is my favourite time of year, because you know why? I get to sit here and look at my financials. It's great, isn't it? No, but seriously, this is the time of year when you should sit down and look at last year's performance. It's the end of financial year, at least in Australia anyway. And now's an opportune time to sit down and go, you know what? How do we do? What went right? What went wrong? And your numbers tell you more than you think you tell them, right? Even if you haven't got a head full of figures, don't worry about it. I'm going to give you a few simple tips today about things to work through and things to look for in terms of your numbers. And this is what I do with my numbers too. So how do we do this? Well, the first things you look for is revenue, of course. How much cash came in the business? Is it up from last year? Is it down from last year? Did we expect it to go up? All right. A lot of this is simply about what I expected to happen and what actually did happen. So revenue is the first one. The second one is your margins. Okay. I'll talk about two sorts of margins: gross margin and net margin, both of which are equally important and both of which actually tell you slightly different things. But let's start with gross margin. All right. Gross margin is the number that it tells you how much it costs you to run your business. Okay. How much it costs you to deliver the services to your clients, or how much it costs you to deliver your goods to your clients. Let me give you an example. So my son the other weekend ran a lemonade stand. We had lots of lemons and he ran a lemonade stand. So what was his gross margin? Okay, he's got sales, people walking by buying cups of lemonade for $2 each. But what did it cost him to actually deliver each of those cups of lemonade? Well, he had to buy cups. That's the first thing. He had to buy lemonade, although we had the lemons, so that was kind of a free input, I suppose. But he had to buy lemonade. And he also bought signage and other materials as well for making marketing signs. But they're not the direct costs of the business, the marketing that is. Okay, so the cost of delivering his lemonade involved his lemons, the sugar, the water, and the cups. For every $2 a cup of lemonade he sold, it probably cost him 75 cents, maybe 80 cents, thereabouts. And so his gross margin, he made $1.20 for every $2 in sales, which, if you do the maths really quickly and in your head like I just did then, it's a 60% margin. Okay, so that's $1.20 over $2, because you made $1.20 profit over $2 in sales. That's a 60% gross margin. That's pretty healthy, right? And so what it tells you, 60% margin, what that tells you is for every dollar of sales you generate, you're going to generate 60 cents in profit. Okay, well, at least gross profit anyway. Because the next part of that is overheads. Right? Every business has got overheads. All right, and overheads includes things like rent, it includes marketing, it includes insurances, all sorts of additional costs. These are costs that you're going to incur. Whether you sell 1 cup of lemonade or 1,000,000 cups of lemonade, you're still going to have an insurance cost. You're still going to have some rent. You're still going to have marketing costs. Okay, that's overheads. Your direct cost of sales, so this is the cost of lemonade, varies. For every, if you sell 1,000,000 cups, you're going to incur $1,000,000 lot of costs for those 1,000,000 cups of lemonade. If you sell 10 cups of lemonade, you're going to incur costs for 10 cups of lemonade. All right, so those two numbers are tied together. But the overheads, which sits down at the bottom of the P&L, is your rent is probably going to be relatively fixed. Your marketing costs are relatively fixed. Your insurances are relatively fixed. Okay, so we take those costs and call them overheads, and we go gross profit, $1.20, minus our overheads. Let's say that's 50 cents. Gives me 70 cents profit. Pull your calculator up and do a good job on your calculator like I do. You go 70 cents divided by 2 is 35% margin, which is a pretty healthy sort of margin. Not bad for a retail business. And so now we've got two numbers. We've got a 60% margin, gross margin, and a 35% net margin. Then what we can do with those information, we can do a lot with that, especially when you look at the stuff over time. So as one moves and the other one moves, you can tell information out of the business. For example, let's say our gross margin improved from 60% to 65%. What does that tell me? That tells me I'm either selling more for the same cost, or I'm selling the same for less cost. Maybe I got a deal on lemonade. Maybe my cup purchases were so great in volume that the manufacturers give me a discount. Either way, it's cost me less to deliver each dollar of product, each dollar of sales. What about overheads? Same thing. If my net, so if my gross margin has moved favorably, but my bottom line hasn't moved at all, maybe my overheads got bigger. Maybe in order to generate more sales, I had to spend more on marketing. Okay, this is where you can start looking at your numbers over time, and you can start looking at them and going, what, how is this business operating? How is it living and breathing? Because your business is a living and breathing thing. Another key metric is wages to revenue. Now, again, depending on the sort of business you might have, your wages might be part of your cost of sales. It isn't my business because we're a professional services firm. If you're a cafe or a restaurant, for example, or a pub or a bar, your wages might be part of your overheads. Okay, it just depends on the sort of business you're operating. But looking at the wages to revenue will tell you a lot about how much it's costing you from people costs, which was usually one of your biggest costs, to generate each dollars of sales. Another good measure is marketing costs to revenue. Right now, in theory, the more you spend on marketing, the more you should generate in sales. And so, again, something that we track over time, and we should be able to see, with any luck, fingers crossed, the more we spend on marketing and the more we invest in our business's brand, in our business's marketing collateral, things like these videos we're doing. Right, if we do these, then we should see an increase in sales over time. And so, again, track this over time. And we'll touch more about that in a bit later on, about things we can do for that. Cash flow. And of course, now cash flow is the other one too, right? Cash flow is really critical. It is, as they say, the lifeblood of your business. Without cash, your business dies. And so ways of looking at this over time is how much cash have I got on hand? Has it increased this year over last year? A great measure for a lot of businesses is debtors ratios and creditors ratios. You say, well, what's that? Well, quite simply, it's trade debtors, as in how much does people owe you, over sales. Okay, you times that by 365, it'll give you a number. Maybe the number's 47. Okay, what does that 47 mean? It means it's taking you 47 days to collect the cash, on average. Let's take your creditors. Let's say you put creditors over sales, so over cost of sales, right? Or over overheads. And you get up a number of, 31. What does that mean? Well, that means on average, it's taking you 31 days to pay your invoices, to pay your creditors. All right, we got a problem, haven't we? Because I got 42 days to collect my cash, and I'm paying out revenue. I'm paying out my costs at 31 days. Well, there's a gap because it's taking me longer to collect my cash than it is to go out the door. Hence, I'm cash crunched. Right. So monitoring these sort of numbers over time is also really, really critical because you want to keep those two as close as possible, or you want to actually make your days debtors, your number of days it takes you to collect cash, less than your creditors. So how do you fix this stuff? Well, from a debtor's perspective, you get your invoicing out fast and you bring people who are late. Maybe you bring in your payment terms. We have standard 14-day payment terms, right? And part of that is because if it takes me 14 days to collect my cash, actually takes about 20 days on average because some people pay late, we pay out roughly 30 days, 28 days on our creditors. Okay, and so obviously you can see there that the cash coming in is occurring faster than the cash going out, which is healthy for cash flow. If the number's the other way around, it's unhealthy. So when it comes to gross margins, how do you improve gross margins? Well, there's a couple of things to think about here. One is the cost of delivery of your services. This is the efficiency. This is the business part of your business. It's not just numbers anymore. It's like, how are you delivering your services or goods? Is there too much wastage? If you're at a restaurant, for example, food wastage in the preparation of food is a critical measure because obviously if you spend more on food but don't sell it all because you're wasting it because it's spoiled, that's the cost of your business. In my business, time is of the essence. It's critical. We sell time effectively. It's what all professional services firms do. So being efficient with our time is really, really important to us. And we monitor this in a number of different ways, but making sure that we're as efficient as possible in the use of our time so we're the most productive we can be. Another big expense for a lot of businesses these days is software costs. Software costs are going up a lot. I think I've had 2 or 3 price increases from Microsoft over the past 18 months. And every time it's 8, 12, 14%. Right? Software is actually a fantastic business. If you've got a successful product, the margins are humongous. But for many, many years, for decades in fact, the price of software has been kept really low as people competed to capture market share. Well, that day is over now and the cost is going up. So measuring your software cost as a percentage of revenue, again, over time, is another critical way of monitoring cash flow, of helping you monitor your expenses. One last thing you should do at the start of this year is actually have a think about your pricing and your pricing strategies. Okay, is it time to have a look at it again? Are you pricing things correctly? Is your product priced correctly? It's not just, is it competitive in the market? Do you have to increase prices? If your costs are going up and you're seeing your margins get worse over time because your costs are going up, then maybe you need to look at increasing your pricing. And of course, I get it, right? There's an inherent conflict here between trying to increase your prices in a competitive market and having competitors come in and take your clients away from you and actually making a decent margin. All right, you've got to balance these two things out. But ultimately, you can't continue to run a business to run it into the ground by making less and less money for every dollar of sales you generate. So if your margin's going south, have a think about pricing. Maybe there's things you can do. Maybe it's just not as simple as increasing pricing across the board. Maybe you could offer different packages. You could repackage your services in different ways. Maybe you could think about when you deliver your products, doing that in different ways, so that there's a premium product that actually costs about the same as your current product, for example. This is where sales and marketing comes into it. You know, how are you positioning yourself in the market? How is your product perceived? Okay, if you've got a great product or a great service, increasing pricing often just goes straight to the bottom line. And two last great measures you should really look at as well. One is tax, effective tax rate. This is my tax expense over my profit. All right? And that'll tell you a lot about the health of your business from a tax perspective. In Australia, small business tax rates at 25% and big business tax rates at 30%. So if you can get an effective tax rate of less than 25%, you're doing great. The final key measure is actually a balance sheet measure. And this says, I've got a balance sheet, I've got net assets worth $1 million, and I've got profit. So profit over net assets. What's my return on equity, right? A really key measure for a lot of businesses, and one that's kind of not really, one that shouldn't be ignored, because you want to generate a healthy return on your assets. Can you get enough efficiencies in your business? And by looking at profit over net assets, return on equity, it'll give a really good indicator about how well you're performing.